All right, welcome in to the webinar of the quarter. And this is a webinar with a new brand. This is the first time that we are actually releasing any, content that is Yetify style. And as you guys can see, in the next couple of weeks, we're going to be launching a bunch of products, which are all going to be helping you on your journey as you tackle investing, trading, personal finance, all of those things. Um, just a quick update from a housekeeping perspective. There are going to be some major overhauls to the Discord community in the next couple of weeks. We are still building out all of those tools, so they will take a bit of time. But once they are done, they are going to change the way the Discord works. We have new research analysis that's coming in. We have some new tools for the flow bots. And also, we will be having some new generation webinars in the future that will be covering different topics from gamma exposure to long-term investing to valuations, et cetera, et cetera. So this year is really going to be a pivotal moment for the transition between Everyday Growth Advisors to Yetify. Now, more on Yetify later, but today's webinar is all about risk management. And the reason why a majority of people are failing with their trading accounts or investing accounts or blowing up their accounts is because they have a nervous breakdown situation. And majority of the time, it is mental. So the real reason why that statistic 97%, 90%, whatever percent of people who lose money is there is because mostly your brain plays tricks on you. So let's get into it. For today's webinar, you will always get obviously an agenda, which we're going to get through in a second here, but really focus on this number, right? That is always thrown around in social media, where, they talk about the fact that 97% of people are, often making mistakes in day trading and losing money. And these are not from bad picks. They're not from a bad trade idea, but it's more from bad decisions when you are under pressure. And that's why the statistic is so jarring, in my opinion, right? So you spent years learning about charts, indicators, setups, and learning how to read different pieces of the macro, the micro, technicals, but then you still blow up accounts. And that's one of the reasons why you're here in this webinar. It's because you're trying to figure out why you blow up those accounts. Well, we're going to answer all of those things today. It's not a strategy problem. This is a nervous system problem, right? And the main thing here is you got to recognize that not everyone is bulletproof, right? Even a person like me, and let me share one of my worst trades ever, in my history of trading, right? This was sometime in 2019 or 2020 when Boeing was kind of in a correction post the COVID meltdown, right? And that was a trade that changed everything for me, right? I had a bias. I was so sure that this business would, be recursive and come back and the price would bounce back. I went so heavy on Boeing, putting down about $5,000 initially. And then I realized that my bias was wrong. How many of you have ever been in a situation like that? Raise your hand if you have, right? Or just give me a quick I have, right? Like where you really want to be right. It's not really about the trade anymore. It's now starting to become about your ego, right? Well, my bias was right. The chart was telling me that I was wrong. I knew my bias was wrong, and yet I decided to double down on my trade. Okay, not because my analysis was wrong or it changed, not because I couldn't accept being wrong, but the trade cost was so high that I got into this sunk cost fallacy mindset, where I had this thought in my head that, well, I've already lost $5,000, so what's another five, right? And that trade actually caused me a lot of mental problems, the following couple of weeks, because I realized one thing. The market wasn't the problem here. It was me, right? I was the problem. And while I was coming up with every single excuse under the book, right, to understand what went wrong and how I should have done something right, there was just no way to explain what was going on. And this made me very, very curious. It made me very interested in understanding why my brain misfired so badly. So I went into a deep hunt trying to understand the psychology behind things. So you wouldn't know it, or you wouldn't really expect it, but your brain has two specific speeds in which it thinks with. Now, a famous behavioral economist and researcher named Daniel Kahneman is one of the guys who first thought of this. So full credits to him. He's now dead, by the way. But he had this idea that the brain works in two systems, right? And I like to call it speed one and speed two, right? So speed one is the part that it has a plan, right? It has a plan. In other words, you're processing a whole lot of information per second, and you check your rules, you compare your thesis, and it slows you down before a mistake. But then there's also the other side of your brain, which is speed two or system two. And this side of the brain is a more impulsive side in which you'll realize that when you are processing, right, you tend to fire before you even finish thinking. So this is more of an impulsive system. Okay. It is definitely not your friend in a trade. Now, understanding and having the acceptance that your brain has these two systems is really the important part of today's webinar. Okay. And I will tell you this now that speed two always wins every time you are in a trade until and unless you know about the 90-second trick, which I'm about to share closer to the end later. Okay. Now, there is a way around this, and I'm gonna show you this system, and I'm going to help you understand how you can take back control of your own mindset when you are thinking about trade ideas. Okay. So there are typically 4 patterns for every blown up account. Okay. These are the patterns that I see. And this is after 13 years of my trading experience. I've obviously done a lot of digging past on my own trading journal. I've asked all of the students that I've worked with, right? We now have a pretty good amount of data sets to work with to understand what's going wrong. And it usually boils down to these 4 things. So I want you guys to kind of give me a little bit of feedback here because this is an interactive webinar. So how many of you have faced either one of these? And I would like you to quickly just tell me if you have faced any one of these. The first one, which is you tend to hold losers, right? This is like the situation where you are 3 days in waiting to get the trade back to even. The thesis is dead. And you know this, by the way, right? But you hold on anyway because you want to be right. You hate losing, you want to be right. So you hold on to the trade, hoping even to get back to even, right? I see a lot of reactions, right? And this is one of the reasons why people blow up accounts. Okay. Second reason, you only read what fits your own bias, your own theory, right? Let's say you're super bullish, then you start looking for bullish confirmations on your bullish idea. You don't look at the reverse of it. So if there's a bearish report on a stock that you just bought, you will close the tab, right? How many of you do that? Right? It's really funny. You don't realize it in real time, but these things happen, right? And then next, you have built a story, right? What does that mean? Well, in this case, you tell yourself that this setup is special. It's different from the last time. You have your own reasons. And what are those reasons? They're your feelings, right? You read the news and suddenly you get over sensationalized. You suddenly realize that, oh man, this feels very different from the last time this happened. But yet again, a couple of months later, and then the market's back to where it was. And the last one, right? You perform really well in a specific period of time, giving you the confidence, or should I say overconfidence, to size up. So let's say you started with the $5,000 account or a $2,000 account, and then you had a winning streak of some kind where 6 months you just sized up and sized up and sized up, and you managed to grow that account really well, right? But then you don't realize that this was all because of some recency bias that happened, and because you had a very good run for a short period of time, but you did not employ the correct risk management rules. So I'm almost sure that there are at least one scenario in here that would be applicable to all of you. Okay. Now, this is the math that most people don't really realize, or they don't really understand. But think about this for a second, because especially when you're trading derivatives, the math of losing is really, really constrained. And let me prove my point, right? So let's say you lose 10% consistently on any trade idea. Well, guess what? You only need about 11.1% to break even. That's not so bad, right? Now, if you lose 25%, you need 33% to break even. But look at what happens when you start to lose 50% or higher. The number that you need in order to make back those losses goes significantly higher. Also, if you somehow lost 25%, you notice that you would have to make 400% on this new capital, right? In order to bring you whole back to a starting position. You realize that if you don't control your losses and you don't control the slippage of your account, then the way for you to make it back, it just exponentially gets more difficult. Are we all on board here? Does everybody understand what I'm saying? Right? The more you lose, the harder it is for you to make that money back. And I know that majority of you know this, but do you really, really know this? Right? So the math really doesn't work in your favor when you're losing and not controlling your risk. So there are 3 rules that you should follow, right? And every profitable trader follows these rules specifically. Number 1, never risk more than you stand to gain. Now, this is if you're in the Discord and you have been, trading with me for a very long time, or you've been a part of the community, you know this is my anchoring rule. There is no setup that is worth it until and unless the juice is worth the squeeze. We could be in the pre-market live, we could be in the Sunday breakdown sessions, we could be in any session, but you will realize that if somebody pulls up a setup and presents it to me, I will never ever think that the setup is worth it until and unless a minimum of 1:2 risk to reward ratio is hit, right? Now, for a majority of you, you might be wondering, like, what is a 1:2 risk to reward ratio? Well, that's simply how much you expect to win out of the risk that you're outlaying. So if you risk $100, a 1:2 risk to reward ratio means that the expected return on the $100 is $200 plus. And the thing many people don't understand is that you don't need to have a very big win rate in order to be profitable using this kind of a system. In fact, the higher that your risk to reward ratio goes, if it's a 1:3 or 1:4, right? The lower the win rate percentage needed in order to be profitable. Okay? So these are all still pretty simple standard stuff, right? The second rule is obviously never risk more than 2% of your account on a single trade. Now, think about it for a second. For a person with $5,000 in their account, 5K, right? What is 2%? Right? It's just $100, right? For a person with $10,000, that's $200 max risk, right? Now, think about this in perspective of how you trade derivatives and other instruments. Majority of people, retail traders, do not have hundreds of $1,000s in their brokerage accounts, right? They're typically trading between $5,000 to $10,000. And that's if they're in a really good position. Majority of them are starting to trade with $2,000 or $3,000. And this is the reason why I say, if you're going to start your trading career with such a small account and you're going to attempt to trade derivatives or options with it, don't even bother. Why? Because the math doesn't work out, right? Think about it. $5,000 account, right? You can only risk $100 per trade. Now, all of y'all in the chat, tell me, can you buy good quality options for $100 these days? It doesn't matter what ticker. It doesn't matter what, expiry. But can $100 buy you a good quality contract? Can it?
No.
No, absolutely not, right? So why kid yourself? This is another reason why one of these rules are often broken, and then you end up risking more, right? You have a $5,000 account, so suddenly if the average options positioning price is between $400 to $500, what have you done now? Now you have increased your risk load from 2% to 10%. This is 10%. Now, this is a significant factor because if you risk 10% every single time, what does that mean? You only have 10 attempts, 10 times before you lose and then you blow up your account. And remember what I said earlier, the more you lose, the harder it is for you to double back, right? So the moment that you get past 50%, this is a point of no return for your portfolio. This is where typically a lot of retail traders end up blowing it up. Why? Because they have already lost 50% of their account, so they think, well, what's another 50%? Right? And then they get into the sunk cost fallacy, which is something that I just shared with you guys about Boeing, right? And that's how things just unravel and spiral, and then you end up blowing up your account, right? So the reality of the situation is be realistic with your risk assignments. If you're risking $500 on a $10,000 account, you are still stretched in risk assignment. However, if you have a bigger size account, well, then yeah, it kind of maybe makes more sense, right? And you guys really need to stop with the one-sided 0-day holy grail kind of trades, right? Where you're taking unnecessary risk and blowing up your account, all because you love watching the contracts move fast, right? Yes, there is an opportunity to make money, but it doesn't mean that you have to be in every opportunity, right? Now, the third rule, and arguably also really important, is your stop loss is decided before you enter the trade, not during. Because the moment that you decide your stop loss inside of the trade, guess what happens? You will immediately engage system 2, the impulsive system that your brain is used to using, okay? So your entry, your stop loss, and any other pertinent trade structure has to be ironed out and locked in before the trade even begins. This is another reason why people tend to make mistakes, because they think that something's going to happen. They enter the trade, then they set their stop loss right after they enter the trade. And because your entry was dynamic, guess what happens? Your stop loss becomes dynamic. And because your stop loss gets dynamic, this typically ends up being a wrongly placed stop loss, which then converts you into being in the wrong trade at the wrong time. Okay? Is everybody okay and simply following along so far? Can I get a quick yes or a quick thumbs up that you're following along? Excellent. Thank you. Now, the thing is, you already kind of know the rules. Okay. Every trader who has blown up an account, they actually know the rules, right? They kind of know, they know that the 2% rule is not the same, right? And when the trade is down 1.8%, you're convinced that it's about to reverse. The thing is, knowing the 2:1 rule is not the same as closing a winning trade 1:6, right? Because you got nervous. Emotions play a very big part. So it's not really the rules, right, that are not keeping you in check. It's the fact that you override them. How many of you have overridden your rules over and over and over again? All because you felt something was different, something was wrong, something was right. The reason is because you're overriding your rules. And this webinar is going to address that specifically. How do you not override your rules, right? Every single time, it is always the same 2 seconds of pressure that makes the decision. It's the moment when the market is down below a key support level, a key resistance level, and all of a sudden, your trade bias is wrong, and you decide fight or flight, and you flight every single time, only to watch the market reverse against you and then go into the direction that you initially thought it was going to go into, right? This risk management that we talk about, right? It's barely a math problem. It's not. It's a behavior problem, right? So you've tried to fix this. You've read the books, you've set the rules, you break them anyway. So what, right? So what? Well, here's the thing. Information doesn't override instinct. Here is the main golden words, right? Your brain cannot think its way out of a feeling in real time, right? Let's say I'm in a trade and all of a sudden it breaks my key level and all of a sudden I'm in a situation where my stop loss is about to hit. I can't outthink my way out of that situation, right? And reading about, like, for example, reading about fire doesn't stop your hand from flinching when you get close to it, right? It's a response, right? So knowledge changes what you know, but it doesn't change what you do under pressure, right? So the main crux of this webinar is that there is a 90-second window, which majority of you might have encountered this before, right? Between the emotional impulse and a bad decision. And most traders don't know that this 90-second window exists. And you're about to use it on every single trade after this webinar, okay? So here is the 4-step reset. This webinar is pretty straightforward and to the point. But remember, after we're done with this webinar, I'm going to go through some real examples using charting so that you guys can also get a good idea on what kind of setups I'm talking about and how do you put that into play, right? So here's your 90-second framework in order for you to not mess up. Every single time that you feel that emotions are showing up and you're feeling anxious, you're feeling worried, you're feeling like you might want to get out of the trade or you're unsure, use this guidelines. The first thing you need to do is obviously pause. What does that mean? 90 seconds. Literally time yourself if you need to. Step away from your computer, right? Your speed 2 or the system 2 in your brain, the one that's impulsive, it needs a period of time to activate. Okay. This is the real risk management here. So you have to ask yourself immediately, first of all, step away from your desk for 2 minutes, a whole 2 minutes, and ask yourself, is this urgency real? This urgency, this desire to put a trade on, this urgency to get out of the trade, right? Is it real or is it manufactured by the emotions coming from the chart? The second thing you need to do is you should probably name it in your, whether it's you write it down or you name it in your head. But you need to name the emotion. You need to write the emotion or name it and say, I am feeling this. I am feeling fearful. I am feeling FOMO. I am feeling scared. I am feeling anxious. I am feeling. You need to note it down because this is how you activate system 1 instead, which is the more logical part of your brain. Okay. For example, which of the 4 patterns am I in right now? Right? Now, later on, you're going to see at the end of the webinar, I've prepared a cheat sheet for you guys. This cheat sheet is printable, and you can keep it beside you while you're trading so that you can refer to it and quickly write things down when you need it, okay? Next, you do a pre-mortem, not a post-mortem, a pre-mortem. You need to assume that this trade is already lost. I've lost it already, okay? Write down the most likely reason why the trade lost. These are steps for you to engage your critical thinking and avoid confirmation bias. I'm not talking about the worst case scenario here. I'm talking about the most likely scenario. So, for example, you take a trade and you know, like maybe there's a setup that's bullish, right? And your bullish bias is blindsiding you and it's blindsiding your entire protocol. Well, the problem here is you haven't explored the exact opposite idea. Well, my trade idea might be bullish, but the market might be bearish. Okay, now I have a better understanding of where I stand, right? So you need to ask yourself, if this fails, what's the honest reason on why it can fail? You guys will see me doing this a lot of times, right? Even during my preparations, even the Sunday breakdowns, I always look at both sides of things because that is the best way to avoid a bias. And then, lastly, you decide, right? You return to your written plan, not the mental one, right? And remember, no plan equals no trade, right? How many of you trade without a plan, first of all? Right? Where you're thinking of a trade idea, but you don't have it concretely planned, where I have the entry, I have the stop loss, I have the take profit, right? Something like that. Oops. Right? Where I have my take profit, right? And majority of time, the thing is people tend to not do the planning step. They skip past all of this, right? So the markets move on a narrative, but your plan has to be solid in order to make sure that the narrative doesn't shake you to your core. So am I executing a decision or am I making a feeling disappear here? Is it the itch that I'm trying to scratch on becoming right? Like, is that what this is? Or is that truly an opportunity here? Right? Okay, I have a quick live workshop for you guys. Very quickly, let's run through this. Is everyone here? It's a very quick one. 5 questions. I want you all to answer, right? So you just type A, B, or C in the chat for each question. There is no right or wrong answer here. Just be honest, okay? So let's do it really quickly. Number 1, you're down 15% and your original trade thesis is broken. Just the only thing I require for this quick workshop is honesty, right? What's your choice? Are you going to cut the loss now, hold and wait for recovery, or add more to average down? Well, for me, I'm going to go with A, right? Okay, great. Now, question 2. A stock you passed is up 40% this week. Everyone in the chat, let's say whatever, is talking about it, right? What are you going to do, right? Are you going to buy immediately, wait for a pullback, or move on? It's not my setup. Okay, a lot of B's here, right? Mine is personally C, right? I will move on. It's not my setup, right? You guys know this about me. I typically do not trade setups that have moved, right? Okay, and then 3. After buying a stock, you see a bearish analyst report on it. What are you doing now? Do you read it carefully and weigh it, or do you dismiss it? You've done your research, or do you feel annoyed that it even exists? A, yep. Okay, cool. Next one. You just took a painful loss. How quickly do you open your next trade? So A, within minutes, I need to recover. B, a few hours later, or days later after your reset. Okay, quite a bit of C's, quite a bit of A's, quite a bit of B's. This is the mixed one, right? For me, it's probably C, right? I take days because I like to really reset, right? Last question. Try to explain your current trade thesis in one sentence right now. Let's say you have a trade thesis of any kind, right? So A, yes, I can do it clearly. B, sort of, it needs some context. Or C, not really, it's more of a feeling. In other words, how is your way of explaining a trade thesis? B, a lot of B. So sort of, it needs some context, right? Okay, great. Okay, well, what do these results tell you about yourself? Let's go look at them. This is a really nice way to get a live understanding of how other people think too. This is the reason why I put this live session here, right? So, okay, so question number one, if you answered, right, B or C, right, which is you held or added a losing trade, then guess what? Your major problem is loss aversion, okay? The problem here is that it's a position in which you are feeling your losses and your gains significantly differently. So your opportunity cost is, assertion is completely out of whack, right? You basically do not have a good understanding of what risk and objective return should be. So the thesis is dead. You're holding up to avoid a feeling that's wrong, and the position is no longer a trade, it's a rescue mission. Right? Does that make sense? Second question. A stock passed 40% this week, right? If your answer was immediately buy on a missed move, then guess what? Your main problem is recency bias and FOMO. The recent 40% is overriding your framework because it's such a big number and it's like, wow, it's 40%, right? But you're reacting to what just happened, not what the setup actually is, right? Question three, very quickly. After buying a stock, you see the bearish analyst report on it. What do? Dismiss it or felt annoyed if you chose one of those? Then guess what? You probably suffer from confirmation bias, right? You've already decided. You're filtering for evidence that confirms your thesis, not the evidence that challenges it. Now, this is one of the biggest problems in the trading community. The problem is the big egos in the room, right? They all want to be right. They all want to get a pat on the back and say, wow, you made us 1,000 gajillion doubloons, right? I don't know why I said doubloons, but the point is, you want to be right. And your confirmation bias is what's keeping you unprofitable. So you have to really, really start to realize that if you don't start looking at the opposite thesis and start pricing that into your trading idea or the trading framework, then you're going to lose out, right? And then next one, how soon do you go back into the trade, right? Right after you have a painful loss. If you answer back in the market within minutes, guess what? There's a very high chance that you suffer from revenge trading. This is where system 2 is the most active, right? Because think about it, right after a loss, there is a moment in which your ego is very fragile. Not only that, there is that moment when you're also kind of like wrapping up the previous trade and you're thinking in your head, well, I could have been wrong. Maybe it's going to go the way that I wanted to go anyway. Let's try to, get back what I lost. This is a very common problem, guys, right? It's where your emotions just go spiral, 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 and then all of a sudden, the next trade isn't a trade. It's an emotional response in disguise. And you don't realize it because it's your system 2, which is meant to be a responsive and intuitive system, right? And then the last one. You try to explain your current trade thesis in one sentence, right? If you chose B or C where you need context or you couldn't explain it, guess what? You probably suffer from narrative fallacy. This is where the thesis lives as a feeling, not a fact. If you can't say your trade idea in one sentence, with a exact explanation on why your trade idea is real, then you're trading a story that you built after the fact. Now, I know many of you suffer from this one. This little exercise was there for you guys to see how everybody else also responds to things, right? You're not alone in this. That's the most important thing that I want to highlight, right? So before you touch any trade order button, you need to ask yourself this checklist. Number one, does my thesis still hold? You have to be able to write it in one sentence, and if you can't, there is no trade. Okay. Where is my stop loss? Exactly. Where is my stop loss? Not a zone, you need an exact number, pre-decided, non-negotiable. If it hits it, it's a great thing. It means that your risk management strategy worked. Many people think that when your stop loss is hit, it's a bad thing, but it's not, because you're managing your risk. The reason why people don't like their stop loss being hit is, you know why? It's because their entry was wrong. And because their entry was wrong, their stop loss automatically becomes wrong, and therefore the trade idea gets washed, right? The third thing, what is my position size? Risking less than 2% of your portfolio. If you feel sick losing this, right, then you're oversized. Very simple. If you closed out the trade, you stopped out or whatever, and all of a sudden there's that sunk stomach pit feeling, well, guess what? You have definitely oversized. And you need to definitely lower the size and gain some confidence first before you get back into sizing up, right? And then second last, what is my time horizon? Is this a day trade, a swing trade, investment? If you don't know, then the market's going to decide for you. It's really simple, right? But you have to decide it in order for you to understand. And the last question, am I emotional right now? Right? You run the 4-step reset first, and excitement is speed 2 talking, system 2. Everybody good so far? Excellent. So 65% of outcomes when traders have external accountability. Every professional athlete has a coach. Knowledge obviously does not change your behavior under pressure, but repetition, feedback, and accountability does. Now, this is the sad reality. Most people will go watch this. They will go back to their desk and basically do exactly what they did before. Not because you're lazy, but because one webinar changes what you know, but it doesn't change what you do under pressure, right? However, it takes 60 to 90 days of repetition to rewire our brain and your behavior, right? So now you guys know that I hold private mentorships sometime. We are now currently developing a new system. I thought I would want to actually show it to you guys today. This is something that kind of helps with what you may be going through individually. But I'm going to get to this in just a second. What I do want to share with you is the emotional regulator checklist, which I have built. And I will send this to your email after the webinar, so you have it, right? But this is the checklist that I was telling you about, which you can print out and you can stick beside you, right? It'll have the 4-step reset, the bias fingerprint, and your checklist plus risk, right? Everything will be in one page so that you kind of have it all with you. So pause, name it, pre-mortem, and decide, right? And then for your bias fingerprint, you have your holding of losers, ignoring bad news, chasing the move, and how to not do these things. It's just a very simple checklist, okay? Here, whether your thesis still holds, your stop loss is set, your position size, your time horizon, your emotional state, and your risk rules are in the bottom here. So this will be sent to you. And remember that the market opens again tomorrow. You now have 90 seconds, so make sure you use them. Okay, now I want to get very quickly into what I've been building. I'm actually really, really excited to show you guys this because it is something that has taken me quite a significant amount of time. This is a offering that I didn't see would be something that I would do 3 years ago. But now that I have had a lot of students under my belt and we have been going through a specific system, I built something that is very, very impactful. This is a guided process that identifies the specific pattern that is running your account, and it replaces it with something that works well under pressure, right? It's 9 private one-on-one sessions built entirely around your patterns personally, and it's your bias fingerprints identified in session 1. And so far, we've had almost a 60% improvement in mentees who have come through this program. Here is one of the testimonials from the mentees, which is also on the Discord. You can see a majority of them. This is the one in which is highlighted here. And here's what it kind of encompasses, okay? The first thing is, you don't need to worry about, oh, I don't know if it's a fit for me. I'm going to post a link in the chat right now, and you can schedule a 30-minute discovery call with me. If this webinar is not really something that you think is going to help you, what I do recommend is you schedule this 30-minute call with me so that we can kind of first of all figure out, are you the right candidate for this? Okay. The whole point of this is to, first of all, figure out your bias fingerprint, which means we'll know exactly what is the pattern that is costing you money, right? It'll be built entirely with a custom curriculum tailored to you. You will have accountability with me personally, right? And then on top of that, you'll have community access. So I'm really, really proud to present to you the Phoenix Mentorship, which is part of the new Yeti system. This is a system which we have developed from the ground up, in where you have academic and cognitive work all built into dashboards for you to complete and understand about yourself. You start off the entire session system with the session 0 that allows you to, first of all, figure out your risk tolerance assessment. After which we get into an exercise which I like to call Snap to Reality. This is where you have a snapshot card, you rate yourself out of 5 on various topics that are important for your trading career, right? And we do your strengths, weakness, opportunities, and threats together, okay? While you're doing all of this, you will also get a selection of modules that you can choose from for me to then build a custom curriculum for you, okay? So you have things from market structure, passive investing, fundamental analysis, technical analysis, trading execution, options, derivatives. Out of these things that you choose, I will then put together a custom curriculum for you to plug the knowledge gaps that you might be lacking. This is important because you cannot just solve the overlying or underlying cognitive issues without also solving the knowledge problems. And this is something that I've learned over time. We will then focus on your money origin story. How did you grow up thinking about money, right? And we will also do something called the 5 Why Dig, which is where we drill into your existing issues and how to get around them. We then get into the gut check lab, where we're figuring out what actually drives your gut behavior. And then your bias fingerprint, where we really, really dial into each and every one of your existing problems. From here, we'll be able to triage exactly what is bothering you. And we'll be able to take all of this into the pressure cooker, where we stress test everything. And we watch how all of our decision-making plays out. After which we create a rule book out of which to operate by. And the accountability mirror, which helps you see things from another perspective. before ending the last session with the Phoenix card, which is a deliverable and also kind of a thing that you can refer to whenever you are feeling lost because you have now done the work and you now have a better understanding of what all of your internals are kind of helping you or not helping you, right? So each session in the cognitive work is a psychological exercise, and it is done outside of class, right? Uh, it's introspection, pattern recognition, and it deep dives into the ego space and the self space. But this is where the real work kind of happens, okay? So this is kind of taken me quite a bit of time to do, make, and over the years, I've consolidated the knowledge that I've gained. And yeah, it's definitely something that I'm very excited to launch. So I thought that this would be a great time for you guys to all see what this looks like. If you're interested, I put the link to the Calendly in the chat. Click on it, book a session with me, and we can talk about it. Okay, now back to a little bit about risk management. And we're going to end this webinar really soon. Now, let's bring this in a closing sense before the webinar ends into the real world, right? Because it's really easy for us to talk about all this stuff, but then, you know, if you're not a part of the premium Discord and you don't attend the live trading sessions, you typically will not understand how these things play out in real time, right? So let me give you some perspective, right? Let's say, you know, you're approaching an area like, for example, on Tesla here, where you have multi-time frame support level where you know this area has been supported. Well, your brain is telling you that, hey, this is a good spot to take risk, right? But then the market at the same time is painting a picture in which it has further downside, right? And even the tech sector, for example, QQQ, right, shows a potential further downside, right? Now, but what the problem is here is if you just used system one or speed one in thinking, you would probably avoid the mistake. What is the mistake? The mistake is listening to speed two or system two right off the bat that, hey, look, this is support, 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 support. So therefore, this support will definitely work out and this will bounce. This is a real-time example of what we've just learned in the webinar, right? What is the problem here? By looking at this bounces and past data, what are you building? You're building a bias. You're now built a bias in your head that, hey, Tesla might bounce. Granted, you might be right, okay? But the point that I'm trying to make here is that, number one, have you followed the rules of engagement where you know exactly what the trade setup is, where your stop loss is going to be, where it makes sense, where it doesn't make sense, right? And so let's use what we've learned today in the real world setups to show you how you should work around these kinds of situations. Well, in this case, if you're looking at Tesla and you know that it bounces in this region, so to speak, most of the time, then what about the indices? Are they also going to bounce in the same space? Well, the thing is, you don't know when the indices will bounce for sure, right? We don't have a crystal ball. But what we do know is that this SPX, for example, has a little bit of space further below it, which might cause a potential sell-off further, right? Back into 6,500, right? And the same thing can be seen on SPY. Excuse me. Now, the first thing you need to ask yourself is the juice worth the squeeze, right? So if you get into from your bigger time frame into a smaller time frame, you can actually start to plan the trade, right? Okay, well, let's say Tesla opens up here, wherever it is, right? I'm going to use my long position trade planner to try and see if this setup is good, right? Well, okay, where is my potential entry point? Well, my potential entry point can be anywhere between here to here, right? This could be my entry. Now remember, I'm using the bullish setup first. What am I going to do after that? I'm going to flip the entire thing and then look at the bearish setup after that, right? Because remember, what do we want to avoid? Confirmation bias. And we don't want to have that narrative fallacy where we have already hard locked a certain scenario in our head and our bias is consuming us. And then all of a sudden, what's going on? System 2 is just taken over. You're now impulsive. You're now like excited about the trade. Oh yeah, this is going to bounce. It's going to bounce. It's going to bounce. You have believed yourself that it's going to bounce. And all of a sudden, you enter the trade, right? So let's avoid all of that. This is why you need to plan. You need to meticulously analyze. You need to weigh out all of the different options and what can happen. And you need to think of it in a way that's logical and engaging system 1. In other words, you have to ask yourself how, why, when, all of those questions before you take a trade. So let's say your entry is somewhere in this region. Well, your stop loss is obviously going to be below this point here, right? And you won't make your stop loss perfectly right below this because you know by now that you're smart and the market maker will definitely come down to try and stop you out before running on you, right? But where would your take profit be? Well, it could be up to here, which is your previous highs. It could be up to here, which is also your previous highs, or it could be up to here where there's previous highs. So you really have 3 take profit targets here, right? Now, in order for this trade to work, well, let's say realistically you're taking on all this risk. If you take this as your profit target, does that make sense? No, it doesn't. Because what is your risk to reward ratio? 0.87. What is our golden rule? We want to stick with the 1:2, right? So is this a good trade setup or not, everybody? Can I have a quick response? Not great, right? Okay. Well, now what if I aim for the second target here? A 1:1.5. Is this good? Not really neither, right? And now what about the last one? 1:2, right? It's about 2.22. Okay, great. Now I know that this is the right target for the right entry. But is this setup realistic? This is the next thing you need to ask yourself, right? The thing is, understanding the setup and planning it out like this is just one piece of the move, right? Because realistically speaking, right, if Tesla were to move, for example, from this general area to this area, how long would it take to get there? Well, based on what we are seeing, right? The swing high, the swing low, the swing high, the swing low. What is this timing window? This is February 26th. The lows occurred on March 3rd. So that's approximately just over a week. This lows and this highs from March 26th, sorry, from March 3rd. Oh, this was February 25th to, yeah. So that's about, yeah, about 1 week, 10 days. This was only about 2 days. And then this was only about 3 days. And then this was approximately 2 to 3 days as well. So you need a minimum of a 1 week out expiry, right? A minimum. That's minimum you require. Now, the next thing becomes, first of all, you know that this may be the potential target with this kind of risk structure, and you have your stop loss set up, but is this idea actually going to work out? And if it does work out, then how are you going to take your profits? How are you going to manage the risk if something goes wrong? Well, there are a couple of things that you need to be aware of. The first thing you need to be aware of is that this is significantly out the money, right? You're currently at 390, and the target that you're looking for is 420. So you're looking at a $30 move on Tesla. Now, I'm not saying that it's impossible. Tesla moves It can move $20, $30 in a day. That's very possible, right? Or in a 2 days, 3 day period. But it's your selection of the instrument that you're going to trade. That's one thing, right? The second thing is the time horizon in which you choose and your patience, right? These are the defining factors into whether you're actually going to be profitable or not. The other thing is, are you going to wait for the sentiment to worsen and almost get to your stop loss level before entering? So let me share with you something that might help you to better orchestrate your trade setups. You see how you have this stop loss assignment, right? Everybody see that? My advice to you guys is once you have come up with your stop loss assignment, your entry should be as close as possible. Obviously, I'm talking about a bullish position right now, but you kind of get the idea. Your entry should be as close as possible to the bottom of the range of that stop loss. Does that make sense? So in other words, if this is my entry point, which I initially forecasted, right? And this is my edge of the stop loss zone, right? My ideal entry point, if I'm going for a bullish position, should be at the bottom of this range. In fact, if even possible, below the previous low. Ideally, right? Because you realize that your risk to reward ratio, it dramatically improves the more tighter you make your stop loss, right? That's just natural law of risk management. The problem is, let me tell you what the problem is. The problem is that if you keep your entry here, you tend to negotiate with yourself that this is an acceptable entry, this is an acceptable entry, this is an acceptable entry. That's what you tend to do because you think that this is the range in which you need to enter the trade. But you don't realize that the closer you bring your stop loss down into the range where you're actually supposed to get stopped out, that's where market makers are usually hunting down people, right? So try to enter at the lower range of your stop loss, somewhere here. And you will realize that the more you do this and you wait patiently, right? Patiently wait. If it runs, it runs. But if you're patient and you wait, you will realize price will always gravitate more towards your extreme point. Now, why am I hounding you guys about this? Because what happens is when we enter wrongly, let's say, for example, Tesla decided to bounce somewhere here, right? Where my entry point was. And Tesla bounces. Well, guess what? If you chase this, right? And let's say for some reason you entered here now, where is your stop loss? You realize your risk assignment just went completely whack. You're taking on all of this risk. Now, here's the crazy part. Traders, instead of realizing that their risk to reward ratio has gone out of whack, what do? Can someone tell me? Someone tell me. This is the biggest cause of problem. More space for stop loss. Average down. Okay, yeah, okay, those two could be, yeah. But I'm saying, even if you don't average down, here's what people do that costs them a lot of money. They move their range of the stop loss tighter in order to accommodate, to inflate the risk to reward ratio in their favor. Do you understand? So they say something like this. They'd be like, oh, my entry was here. Shit. So now my stop loss is here. Like, and then they will concoct everything in their head to align this. They'll say, oh, look, there was a previous support here too. It doesn't have to be this one, right? I can be right. Right? You guys done that before? I'm pretty sure you have, right? Don't joke with me. I know you have, right? Now, here's the problem with that. Because you did this, you have not taken into account the real possible stop, which is below the previous lows, in which the market maker might have incentive to come and tap on and collect all of this liquidity before sending it up. And then what do? You stop yourself out, and then you're like, oh shit, it's gone further down. Then you enter short here, reversing your whole thesis. Stock comes down. You get to this point, you're in slight profit, but guess what? Now your ego's in the way. Yes, I was right. I took the reverse position and it's worked out. You're plus 15% or 10% here, and guess what? Your ego says, or rather system 2 says, 10% or 20% is nothing. It can go to 30, 40%. We've rejected this level, so it will definitely go down. And bam, comes down. You don't close out the trade. You don't take profits. You don't scale out the position. Wham! End of the day, you get 2 losses. Suddenly you're on tilt. You're now trading out of revenge. System 2 in full spiral mode. And all of a sudden, blown up account. You realize that because you didn't plan properly from the beginning, you didn't validate properly in the midway through the trade, you didn't properly stick to your trade idea, that all of a sudden you have cost yourself your entire account. How many of you have been through something like this, right? So how do you not fall into that trap? First of all, come up with a very realistic risk assignment, right? Okay, I'm willing to enter Tesla within this range. Remember, the range doesn't just end at the tippy bottom of this candlestick. Give yourself some room, go further down, right? Because this range can be big. The market maker will press it, right? Once you have established this range, don't hunt for an entry above your prescribed entry zone. Even if the stock bounces for some reason, let it go. It's okay. Maybe you didn't get the entry you wanted. That's fine. There will be other setups. But the more you pay attention to this golden rule, which is get in as close as possible to the bottom of your stop loss range, I'm talking for a bullish position, and I will show you the bearish after this, right? You will realize that you will considerably improve your risk to reward ratio outcomes without changing the structure of the trade, right? And guess what? You then don't have to target this as your take profit. You can then target this, you can then target this, and still maintain a very competitive risk to reward ratio. This is the edge that professional traders and majority of people who've been doing this for a really long time typically don't know how to explain. And this is something that I know how to explain because I realize that over such a long period of time that people make these mistakes over and over again. Okay. So now let's look at this the reverse way, right? The short way. So that was the long, this is the short. Now let's say Tesla gets up, let's say it goes and then like, right, goes like this, like this, like this, based on your thesis, and now it's up here, right? Well, okay, I now know that this is the potential rejection zone, right? Now, remember, I haven't layered all the other data into this. I haven't layered gamma exposures. I'm just talking strict risk management. That is what this webinar is about, right? Once you layer everything else onto it, then you realize, okay, it's a bit easier to understand that, right? But okay, I know that this is the rejection zone. I don't want an exact perfect rejection zone over here, right? And this would technically and it would reasonably be my risk that I'm taking on, right? Risk. And then objectively, this would be my reward. And the reward has many different tiers, right? It has one where I can go for here, I can go for here, I can go for here, and finally down here, right? There are 4 technical take profit levels for my short entry here. Once again, the same thing, right? You come up to here, you reject, and then all of a sudden, you enter the trade here, right? You're taking it, yes, within your risk to reward ratio, but you're not weighted for that imbalance to occur. So there's a high chance that maybe you get a push up again later. Then you get stopped out on your initial trade. When this initial stop out happens, take that 90-second pause. Walk away, reset, come back, start to understand again what has happened. Give the trade time to breathe. Watch for when buyers and sellers are getting imbalanced. That's what the focus is, right? And then if you get a better entry towards the high of the range, and at the same time the indices are confirming that it's weak, then guess what? You have a short trade on your hands with a very good risk to reward ratio, right? So I'm not going to re-explain the whole thing because I think you kind of get the idea. If everybody understands what I've been talking about and you have had some kind of a revelation today, could you please tell me that or respond so that I know that you understand? Everybody good? I see one yeah. Okay, two. Okay, excellent. That opens up for Q&As. So I'm going to give a quick Q&A. Any questions, comments, anything at all that you guys want me to answer from this webinar or this space? And then we're going to end the session. So I'll give you guys about 1 minute, 2 minutes to ask questions. Go ahead. This is great info T. I'm already doing some solid self-reflection. That's awesome, dude. From thousands of stocks, how do you screen out your setups? Is Phoenix taking over EGA course? No. There is, okay, let me answer these first. From thousands of stocks, how do you screen out your setups? Okay. I don't look at 1,000 setups. I have a list of maybe 10, 15 stocks that I know really, really well, and I've been looking at them for over 10 years. Like, I know Tesla really well to the point where I know exactly what it's about to do if it is in a momentum phase. If Tesla's, for example, if Tesla's consolidating, I will never trade it. If Tesla's in a momentum phase, I will trade it because I know how it trades. Right? That's just something that you need to learn over time. So how do I screen out my setups? Well, my main recent system that I've been improving, making better, and things like that is one of which we pay attention to the gamma levels, right? Through a indicator setup. For example, we have this by MentorQ, which is a software that you can purchase. And it gives you a insight on where the gamma levels stack up to my setups. So case in point, if, for example, I like Tesla setup, and I know this is market maker data. So this is essentially, you know how you have your, what is it called? Dylan, what's that software that you use? The one that shows you the gamma exposures? I forget the name.
This was quant data.
Quant data, right? There's quant data, and then there's one more. Okay, they give you the gamma exposures, but they don't
Trading ticks.
Yeah, Traditics, yes. So there's that quant data and Traditics that give you the gamma exposures, but they don't visually show you what it looks like on the chart. MentorQ has solved that problem. This is one of the reasons why we are partnering with them in the future, right? And so when you populate this at the start of the day, it gives you a good idea on where market maker is sitting in this positioning. So it's overlaid onto my chart. So for example, I know that the lowest that they can go today would in that particular trading day would be here at this level. And if we get below this, market makers have to heavily hedge their positions by selling shares. This is where the market maker has sold puts. So therefore, below this, also they're hedging shares, right? And if this is the high volume level, so this is like a magnet to which price will stretch back to, right? This is where market makers have sold a bunch of calls, right? So this is how I refine my setups, if that's what your question is, right? It's something close towards the extremes. Yes, then I'm very interested to trade it. If something is just like in between this range and it's trading like in this area between a bunch of nothing levels, then I completely ignore the setup and I wait till it enters that irrational phase where market makers are forced to take a position. That's how I screen my setups. Okay. Lately, this has been really working out well for me. Though I trade less, I'm getting a much more better responsive to how I'm kind of manipulating around the data. So that's to answer your question, Fabio. Okay. Okay. Is Phoenix taking over EGA course? No, it's not. Phoenix is now going to be a layer in which people who need real deep help. This is individuals that are constantly messing up, and despite them knowing knowledge. So there are two things that are wrong here, and they're problematic. And this is what I've seen over time and time again. Is number one, they have a system, they have some knowledge about the markets, but they are missing particular knowledge to close the loop and transition them into profitability. The second part is they are not aware what their cognitive lapses are. They don't know what their biases are. They don't know what tends to make them tick. And this is because everyone has a different lived experience, right? In other words, maybe you grew up in a household which money wasn't talked about by your parents. And maybe some other person grew up with their parents teaching them all about money. These two people grew up with very different experiences in life. And we need to actually figure out what that life experience has taught them and what their money story is so that we can now triage and figure out why their psychology is acting against them. So I've taken a very long amount of time to build the behavioral finance component, which I've told you guys over a long period of time that I'm very passionate about, and build it into exercises so that we can tackle that and actually know what's going wrong with you, right? And that happens over 9 sessions. And every session is 30 minutes academics. So we go through the curriculum, which is where you're lacking the knowledge. And then the other 30 minutes is the cognitive assignment. So that closes the loop completely. And we've seen substantial improvements with people who have gone through the mentorship. I learned I need to take that pause. Absolutely, Lady TJ. It's something that, you really have to. Fabio says, yep, understood. Your answer hasn't changed for 4 years. It's nice to see that after 4 years when I did the EGA Wave 16, the quality of webinars and education sessions is still top-notch. I started trading again 2 months ago with a very small account, but I will keep working to grow and join the EGA Tribe Discord again. I enjoy your community a lot and seeing it's grown a lot. Even joined the when I was about warms my heart. Oh, that's such a nice message. Thank you, Fabio. I'm not sure if you're aware, but we actually parted ways with Beautiful. There was a business decision that I had to make, which I'm completely fine with, and I'm very happy that we did. But it's been a great journey, and I think that this year is going to be the year in which we are going to really separate from a lot of the basic trading groups and communities out there, because this is the year which we embrace Yetify, which is the platform in which every single person who has money problems is going to come to. And we are trying to build some real tools that help us to help people navigate those issues. We don't want to just be like a degen central. This is not what it is. In fact, our Discord is anything but that, right? If you have been on the Discord before, I'm sure you know. We pride ourselves in making sure that the trading floor is not so noisy and not people saying every single time of the day, oh, I'm long, I'm short, I'm this, I'm that, right? We don't want that. What we want is really good based members that are contributing in a very efficient way. Yeah, I can't wait for you guys to see the upgrades to the Discord. It's really sick. And the things that are going to come out of that are going to be crazy. I'm still testing it. It's going to be really good. Just an update. Through the middle of this year, our Discord is only going to become a yearly member Discord. We will no longer have monthly. What this does, it adds a few different products to the belt. I am working on a completely different approach to how education is done. So the GIT course, which is going to be a bit different. It's going to be done differently, right? Is going to be included in the yearly subscription now. There's going to be an entire portal for you to access everything. We have built everything from the ground up because I realized that when I first started the business a couple of years back, we were just bootstrapping it, but now it's turned into something that's much bigger than I expected, right? So we're working on making all of those things better. And so you'll have access to all of the recordings from one place. You'll have access to all of the YouTube stuff in one place. You'll have access to some tools in one place. The Wolves, the yearly subscription will now be called Wolves instead of Lions. You'll have Phoenix, which will be the mentorship / financial therapy angle of the business, which is the area that we really want to work in, right? For me personally, that's what I feel very passionate about, is what is this term that I'm kind of, moving into. Its financial therapy, to help people through their financials, but in a therapeutic way, right? So Phoenix Mentorship, for example, is financial therapy. And then we have a third product as well, which is the Unicorn Portfolio Consultancy, which is for people who they have a bunch of money, but they don't know what to do with it. They need somebody to hold their hand through portfolio building a custom portfolio. So these are three really big things that are coming to change in the community. So yeah, big announcements, big year ahead. Starting middle of the year, you'll start to see all the changes pop up. And yeah, I'm super excited. But thank you for your questions. Thank you for your time. I appreciate you taking the time out to be here on a Sunday. I'm going to go ahead and stop the recording here. And then those of you that want to hang out, you can continue to hang out. But at least for YouTube, this is where it ends.